And for the overall U.S. banks, you have about $620 billion of unrealized losses on the securities out of a capital of $2.2 trillion. And for some of the regional banks, the number are much higher. But it's not just the securities of lower value. Many of the banks had issued loans like mortgages at fixed rates at 30%, 30 years, when interest rates were 1%, while right now there are 3.5 for 10-year treasuries. So the market value of those assets is also down. People have estimated, therefore, the overall losses for the U.S. banking system for the rise in interest rates, both on securities and loans, are equivalent to 1.8 trillion out of a capital of 2.2 trillion. Hundreds of the smaller banks are literally insolvent. So that's a fundamental problem. When interest rates go higher, the value of securities and loans is lower, and then we have mass liquidity and solvency problems.
Your recent book was called Mega Threats, 10 Dangerous Trends That Imperil Our Future, and I wonder if this is among them. Interest rates at 5% or even 6% don't seem like a mega threat. We've had rates as high as 20% in recent history, in the early 80s. But we have so much more debt now than we did back then, which means carrying costs are much more painful. Is this higher rate regime a mega threat, Nouriel?
It is, because in the 1970s, when we had the stagflationary shock that led to inflation and recession, debt ratios in advanced economies were only 100% of GDP, private and public debt. Today there are 420. So we have the worst of the 70s in terms of negative supply shock, reduced growth and cause inflation, and we have debt ratios that are much higher than after the GFC crisis. And during the GFC crisis, we had the debt problem, housing debt, mortgages, bank debt, but we had negative demand shocks and a credit crunch that led to deflation, so we could do massive monetary, fiscal, and credit easing. Now we're entering a recession and financial instability, having to raise interest rates because the inflation is too high. So we get inconsistency and a trilemma. We cannot achieve price stability, maintain economic growth, have financial stability at the same time. So eventually we'll have an economic and financial crash.
I mean, central banks say they can do those two things. Good morning to you, Nouriel. They say that they can have financial stability and they can control monetary policy because they're different levers dealing with different problems. You doubt that?
Yeah, there is this separation principle that says we're going to use the interest rate policy for price stability, and we're going to use liquidity to backstop the financial system and have financial stability. But that occurs only when the problems of the financial system are purely liquidity and limited to individual institutions. When you have a systemic problem and there is a risk of insolvency, and by the way, an economic recession is going to lead us from duration and market risk to credit risk, you cannot essentially lose liquidity support of the banks as a way of backstopping the system, and there's an inconsistency between price stability and financial stability. And we're headed towards a hard landing, a credit crunch, and significant amounts of losses, both for debtors that are facing much higher nominal and real rates, but also for savers and creditors, because rising interest rates reduces the market value of their creditors' assets. So you have financial instability, price instability, and economic instability.
Nouriel, you used the phrase credit crunch, and we all threw around the term credit crisis in the late 2000s. We know that that led to the financial crisis and everything that followed. How bad do you think this credit crunch gets this time around? We heard the Fed uncertain, and many voices uncertain about how much we see a pullback in the offering of credit.
Well, most of the financing to SMEs and to households in the U.S. occurs not from the large money center banks, but from these regional banks. And these regional banks are in trouble. There is deposit flight, there are uninsured deposits, there are fundamental security losses. There'll be a tightening of credit and credit standards. They'll have to be more cautious, they'll have to raise capital, so they're going to lend more. Credit growth is going to probably go from 10% annualized to closer to zero, and therefore a good chunk of Main Street and Middle America is going to be subject to a significant credit crunch. That's going to exacerbate the risk of a harder landing of the real economy.